What's up, investors? Look, I'm not one to be an alarmist. I just found evidence that suggests that there's going to be economic or market turmoil in the next 4 weeks, sometime before the next 4 weeks. While doing research for cash rate videos, I was just actually doing research on where you can put your cash so you can collect more yield. One of the examples was, Robinhood Gold, which is going to give you 4.4% on your brokerage cash. And I had other examples. I was researching SGOV, SGOV, symbol SGOV. I'll show you right here. That is going to give you 4.64 30-day yield. So that was nice. And then naturally, I went into the treasurydirect.gov site, because there you can purchase debt directly from the government. And I was looking at short duration debt, and I found something very compelling. Okay, now if you were really an expert in bond trading, then perhaps I'm making some kind of mistakes. Please explain it to me. I'm just an investor like most of you guys, so I want to learn. But this seems very peculiar to me. Okay, so here's the story. I went to the treasurydirect.gov because I've bought treasuries there before, all the way back in the 2006, 2007 days. And I haven't gone back since, really. So this is the site here. I was researching, on tips and how they reset. And so I stumbled into this, okay, which is the announcement data and results of the most recent auctions. Now, go through it with me here, okay? These haven't happened yet, but the rate is set extremely weirdly. Okay, so 13-week. So basically, bills, the difference between bills, notes, and bonds is just duration. So bills are between 4 weeks and 52 weeks. Notes are between 2 years and 10 years. Bonds are between 20 years, 30 years. That's all there is. So I was looking at the bills, and look what I found here. So first of all, the Federal Reserve benchmark rate at the moment is 4.75 to 5%. All right. So that's like the overnight rate. That's what things should be trading at immediately. So normally, as you go further out in time, the yield actually increases a little bit. So look, this one is appropriately priced at 5.216%. Okay. And so people are looking to be compensated for having their money locked in for the next 13 weeks. But why, on this good earth, would they be only willing to receive 3.25% for getting it locked in for 4 weeks? Why? What's the matter? Why is it 4 weeks? Why is this imminent auction so important? Look what's happening, okay? Let's go back in time a little bit. So this is the auction on April 4th, 4.7. That's reasonable. A little bit lower, right? So people are willing to pay a little bit of a premium to have it locked in for 4 weeks rather than overnight notes, or whatever they're called. So 4.7, which is below 4.75, right, for the next 4 weeks. So that would be May 4th. But then look, on 4/11, April 11th, they were willing to accept 4.53%, even lower. Next 4-week auction, April 18th, 4/11, they were willing to accept 64 basis points less than the Federal Reserve minimum benchmark. Okay, expiring May 18th, right? So people are banking on there being some kind of a market event where the rates will go down more than 1.5%, basically. Or at least there's a good chance of rates coming back all the way down to 1% or 0 by May 25th. Look at this, 3.251%. A high rate of 3.19. So if that's not enough, right? Let's look at FRNs. So FRNs are floating rate notes, okay? Now those are issued in 2-year durations, and they pay quarterly usually. And basically, these instruments follow the benchmark that is set by the Federal Reserve. So if the benchmark goes down 2%, so does the yield on these instruments. And you get to basically receive less. So I was browsing through the history because I'm like, okay, this 4-year note can't be a strong enough piece of evidence that something is going weird in the markets. So I looked at these FRNs and they kind of confirm it. So here's what I mean. When these turned negative is when it was clear that the Fed is going to hike, right? So they started hiking, so people are bidding this instrument up, right? They're bidding it up because the price of the instrument is inversely related with the yield here, right? So they're bidding it up because they know that the base mark, the base, I lost speech. The base rate is going to go up. So they're willing to pay to get a bad price on this, bad yield, because it's going to climb, right? The benchmark is going to go up. But however, it started inverting, somewhere here in late 2022 because people were anticipating that there is going to be a reversal, right? That the benchmark is going to be lowered, and so they're rushing out of this instrument. Okay, and now this instrument is at a premium because people don't want to get locked in there. Okay, because their yield will fall as the benchmark falls, so they don't want it. And in the past 3 auctions in January, February, and March, they don't want it so much that the spread here, the discount margin, is 0.2%. So this confirms that investors have increasingly disliked this instrument, which basically says that they think the dropping of rates is coming. Okay, it's not as indicative as the 4-week auction, but it confirms the general mentality. So if you think that the bond options and mass are smart and they're able to predict these rate movements, then this is a very strong piece of evidence, in my opinion. So I didn't what do you mean necessarily? I didn't want to make a video on this, but I thought I should share this right as I'm finding it out now. I'm just doing this research for my cash yield return, but this is what I found and I felt like I had to share it. But I need to know, like, I'm going to dig down a little bit deeper to see if I can find anything else. But for those of you that trade bonds on the regularly, I don't know if I have any listeners that do trade bonds, especially on the Treasury Direct side. Let me know if this kind of stuff is normal. Like, why is this happening? I haven't seen it before. Is my interpretation wrong? Am I just crazy or something? Am I just like... I don't even know how to make this video non-clickbaity. Like, a mild signal, ambiguous signal of an imminent market significant event in 4 weeks. How am I supposed to word it? Anyway, so this is just basically what I found. I mean, that's what happened. Like I said, I'm gonna dig deeper, but I'm really looking for answers. So if you know any answers about this, if you're into like the inner workings of the entire, debts. I tried looking at auction results, but I'm having a hard time reading some of them because they just kind of give, the total amount of paper that's floating out there on each auction, and they're not very informative. So if you actually do know a website that goes into more detail as to how competitive a specific auction was outside of this website, perhaps I can try, the Federal Reserve website, which I'm going to do next. But if you know of a website that's got all the numbers really easily visible, then I would really appreciate it if you link it down in the comments below so I can do some more research. And if I find something interesting, I will share it with you and continue, researching this piece of evidence here, this lead. Okay, at the end, it could be nothing. I could just be crazy thinking that this is significant, but I'm not about to adjust the way I'm holding my portfolio based on this. I might if I find even more evidence that supports this market dynamic, but as of now, no change. I'm just really curious about it, and let me know if you can help me out. All right, that's it for now. I will make that video about cash interest at some point. I just want to share that real quick. Maybe I'll make a video tomorrow. Also, I want to do a video on Warner Brothers. I haven't done that, so I will do that in the coming week. All right, that's it for now. Peace out.